Private equity now controls $13 trillion globally. They own companies employing 1 in 15 American workers. And every single year, they extract roughly $1 trillion from the real economy through fees, forced dividends, and asset sales. This isn't investment, it's strip mining. And I've got the data to prove every country that let PE take over paid the exact same price. Dead wages, unaffordable housing, and a rich class that got obscenely richer. Here's where it starts. Domestic credit to the private sector. Basically, how much debt the financial system pumps into companies. Exploded after 2000. In the US it went from around 160% of GDP to over 200%. In the UK, it peaked near 190%. This is the fuel for the leveraged buyout machine. PE doesn't buy companies with its own money. It borrows against the company it's buying, loads that company with debt, then charges the company fees for the privilege. Look at Germany and Japan on this chart. Economies that never fully surrendered to financialization. Their credit to GDP ratios stayed flatter, and their industrial bases stayed intact. The countries that let credit balloon are the exact same countries where PE now owns your hospital, your apartment building, and your dentist. Now the counter-argument. PE apologists say, we're not extractors. We're efficiency creators. We make companies more productive. Fine, let's test that. If PE genuinely made businesses more productive, we'd see two things. First, a healthy, growing industrial base, because efficient capital allocation builds real productive capacity. Second, banks holding solid capital buffers because the lending is sound. We see the opposite. Industry value added as a share of GDP has collapsed in every PE-heavy economy. The US dropped from 22% to under 18%. The UK cratered from 25% to 17%. Meanwhile Germany, the country PE didn't conquer, held above 26%. PE didn't build industry. It stripped it, sold the parts, and moved the money to Wall Street. The efficiency story is a lie the data has already killed. Here's the leverage engine. Bank capital to assets ratios tell you how much cushion banks hold against the loans they make. Lower ratio equals more leverage equals more fuel for PE takeovers. Before 2008, US banks were running capital ratios around 10%. That thin cushion was the accelerant for the buyout boom. Cheap debt, endless leverage, no consequences. Post-crisis regulators forced ratios up, but PE just moved the leverage off bank balance sheets and into private credit funds. Today there's an estimated $1.7 trillion parked in private credit, in regulated, opaque, and lending straight into more PE deals. The system didn't get safer. It got hidden. So who actually got the money? The top 10%. In every country PE dominates. The highest decile's share of income exploded. In the US, the top 10% now captures over 45% of all income, a level not seen since the 1920s. The UK crossed 39%. And look at the countries with weaker PE penetration and stronger labor protections. France, Sweden, where the top 10% share barely moved. This isn't a coincidence. This is the mechanism. PE buys a company, fires workers, cuts wages, sells the real estate, extracts a dividend, then dumps what's left. The wages that used to flow to 100 workers now flow as capital gains to 3 partners. Repeat that across 12 million American workers and you get the exact income distribution this chart shows. Here's the final nail. PE swears its takeovers boost worker productivity. So look at GDP per person employed, the actual measure of what workers produce. American workers now produce over $148,000 per year in real output. Adjusted for inflation, Productivity kept climbing. But wages? Real median wages barely moved since 2000. That gap between what workers produce and what workers get paid is the extraction. That gap is PE's business model in one chart. Workers got more productive. The gains went to asset holders. And the asset holders, increasingly, are private equity funds owned by pension funds, sovereign wealth, and the ultra-rich, recycling your labor back to itself as their capital gains. Let me say this clearly. Private equity is not an investor class. It's an extraction industry wearing a suit. The data shows it in every dimension. Credit exploded. Industry collapsed. Leverage moved into the shadows. The top 10% took everything. And workers produced more for essentially the same pay. The countries that let PE run the table, the US and UK, are now the countries with the worst housing crises, the most bankrupt hospitals, and the angriest working class. The countries that resisted, Germany, France, Sweden, didn't get rich slower. They just didn't get looted. This wasn't a market outcome. It was a policy choice. And it can be unchosen. If you want the actual numbers behind the headlines, not opinions, not vibes, just data that forces a conclusion, subscribe. Every video on this channel starts with a dataset and ends with a verdict. Next week, who actually owns your apartment building? The answer will make you sick.